there seems to be value to be found in at least one container leasing company and a grocery store chain. At least that's what our value stock strategist Tracey Ryniec tells us, and she's here to tell us more right now. The container leasing company, I always find these companies interesting. TAL International? Is that how it's pronounced?
Yep. I think we might have talked about them in the past. I'm sure we have over the years. They're an interesting story because during the Great Recession, the container companies really got slammed down. They stopped producing the containers. These are the big ones you see on the big ships that cross the ocean, and then they put them on a train, and then that's how you get a lot of the goods at your grocery store.
And in this case, dry and refrigerated.
Right, exactly. So when everything died during the recession, basically, they didn't make any containers, and then when the recovery started happening, there was a big demand for containers, but there was a shortage. So container prices went up, there were high utilization rates, all things were really good with the container companies because supply and demand dynamics were really in their favor. But usually it's really cyclical, and that happens for a year or two until the supply catches up with the demand, and then it's not good to be in these stocks. But it's been going on for 5 years now, or 4 to 5 years. And over the years, the analysts kept saying, next year the cycle will be over, next year it'll be bad. But next year keeps coming and nothing happens. So, you know, the fundamentals still really look good with this company. They have a really high utilization rate still, about 97.7%, which means almost all their containers are in use some way. Either they're selling them or they're leasing them. They have a pretty big lease program to a whole bunch of the shipping companies. A lot of those are locked in on long-term leases, which give it a lot of stability so they can see forward with the leases being locked in. You know, they're still expected to grow earnings by about 15% this year, and they've been growing double-digit the last couple of years. You can see in 2014, I put that up along with the 2013. It's supposed to drop off, but that's the analysts again saying, next year it's going to be bad, which they've been doing the last couple of years. But so far, you know, TAL isn't seeing it. They have raised their dividend every quarter for the last 5 quarters, which is a big deal with this kind of company because they will pay a large dividend when things are good. And so right now things are good. They just raised it at 3%. The yield is almost 6% on the dividend with this. So you're getting the good divvy. That shows confidence going forward. And you can see the shares. I put up the 5-year chart. So, you know, they're at 5-year highs, but trading around, you know, little under 10 times. That's a good valuation here. And so far, at least, this story of the containers being strong and demand for them is not ending.
It's a global company.
Yes. Oh, yeah. They're in numerous countries around the world. They supply to all the large shipping lines. It's a good kind of window into what the global economy is doing.
So you're not,
you're not really seeing a slowdown if these guys are having, you know, nearly 100% utilization rate.
So somewhere there's always somebody shipping.
Yeah. So, you know, it's a good sign that we're not going to see a recession, at least, you know, imminently.
Yeah. Okay. The grocery store chain is Safeway, SWY, the ticker.
Yes. Most people know Safeway, or they know one of their brands, depending on what market you're in. They have Safeway brands, and then they have Dominic's. I think they have 1 or 2 other brand names too. Those are the 2 biggest ones. You know, they're a supermarket. It's not super glamorous. It's hard for the supermarkets to make money. They did grow same-store sales last quarter at 0.8%, which isn't too bad for a supermarket chain. You know, they've kind of changed strategies here recently. They started a Just For You loyalty program. It used to be if you used your card, you went in and you got a discount on like a whole bunch of items. And now they've kind of gotten away from that, and you're still using your card, but you're getting like person-specific deals. Like, so you'll get certain coupons based on what you have bought. It's more loyalty and more targeted. And that seems to be working because it is actually driving sales. So, you know, Safeway had a good quarter last quarter. They did beat, you know, earnings are expected to grow 9% here. They just held an analyst day where they gave a little bit better 2013 guidance than the analysts were expecting. So the estimates are up for 2013. 9% growth for a supermarket chain is pretty good. Like they have this loyalty program that's good. Shares are at 2-year highs, so you know, joining in this overall rally that's been going on. You do get a 3% dividend with this stock, which is pretty good. And you know, it's not super expensive, trading around 10 times, but it is a supermarket chain. It's value.
You keep saying it like it's a bad thing.
I know, but not a ton of growth there. But they seem to be figuring out where to find that growth, and it's showing up in their bottom line at least.
Okay, well, those value cards do work. Unless, of course, you're like me and you say to the cashier, I left mine at home. Could we use yours?
Does it work?
It does work.
Okay.
Yeah, but you get a skewed result.
Well, yeah, because now you're not in the loyalty thing
Right.
as much. So that, yeah, they definitely want to encourage you to use your own so that they
Or
can
they're
target.
mistaking my loyalty for somebody else's.
That's right.
Do you own either of these two?
I do not.
All right. Check out other stock picks and stock pick strategies. They're over on our website, Zacks.com. So if you're not there already watching this video, then get on over there and check them out. With Tracey, I'm Terry Ruffalo.